if you're starting a business in India, you know all about those initial costs, right? They pile up way before you even open your doors for business. But what if I told you that you could turn those expenses into a pretty significant tax advantage? Well, with the new Income Tax Act of 2025, the game has really changed. So let's break down exactly how you can claim those setup costs. So let's get right to it. You're launching a new venture, and you've probably invested a good amount of money before making a single rupee in revenue. The huge question on your mind has to be, can you get a tax break for all that pre-launch spending? The answer, can seriously impact your cash flow during those make or break early days. And the answer, thankfully, is a big yes. The key to unlocking this benefit is Section 44 of the new Income Tax Act 2025. This entire provision is designed specifically to help businesses just like yours. So how does it all work? Let's dive in. Okay, so Section 44 gives you a structured way to treat your preliminary expenses. The idea is they're not just a sunk cost, but a legitimate tax-deductible expense. But, and this is important, you can't claim it all at once. The law uses a concept called amortization, which is just a fancy way of saying you get to spread that deduction out over time. So what exactly is amortization? Well, think of it like this. Instead of taking one big bite out of your tax bill in the first year, Section 44 lets you take 5 smaller, equal bites. You get to deduct 1/5 of your eligible expenses each year for 5 years in a row. This gives you a really nice, steady tax benefit during that crucial startup phase of your business. So, who gets to take advantage of this? Well, the good news is it's not just for big corporations. It's available to all Indian companies, of course, but it also covers other resident taxpayers. We're talking individuals, partnership firms, you name it. And it applies in 2 main situations. First, for all those costs you rack up before launching a brand new business, and second, for the expenses of expanding an existing business by setting up a totally new unit. Now, of course, you can't just claim every single rupee you spent. The law is very, very specific about what kind of expenses qualify and, just as importantly, how much you can actually claim. So let's get into the nitty-gritty. If you look at Section 44, subsection 2, it gives you a very specific list. We're talking about the real foundational work, things like preparing feasibility reports, conducting market surveys, and getting essential engineering services. It also covers legal charges for drafting those core documents, like your company's memorandum and articles of association. The big takeaway here is this. Your expense has to fall squarely into one of these approved categories. No exceptions. And here it is. This is probably the most important number to remember when it comes to the limits. The total amount of preliminary expenses you can claim for this deduction cannot, I repeat, cannot exceed 5%. Now, 5% of what, you're probably asking? Well, that actually depends on your situation. This is where it gets interesting, because the calculation is different for new and existing businesses. For a brand new business, that 5% limit is based on the cost of the project. That's basically the actual cost of all your fixed assets, land, buildings, machinery, at the end of your very first tax year. But for an existing business that's expanding, the basis is different. It's 5% of the capital employed, which is the total of your share capital, debentures, and long-term borrowings. Getting this distinction right is absolutely crucial for staying compliant. All right, so knowing the rules is one thing, but how do you actually go about claiming this deduction? Let's walk through the compliance roadmap. We'll cover the forms you need, the audit requirements, and the documents you absolutely have to keep handy. The whole process is actually pretty systematic. Step 1, you compile all your expense records and double-check that they qualify. Step 2, and this is a big one, it's mandatory. You must get your accounts audited by a chartered accountant. Then, your CA will help you prepare and file 2 key forms. Form 5, which is the statement of your expenses, and Form 6, which is the audit report. And finally, you upload and verify them on the tax portal. Simple as that. This brings us to a really crucial point about compliance. Even though you aren't uploading every single bill and receipt with your forms, the official guidance notes are crystal clear. You must maintain all of the supporting documents. Just think of it as your evidence file, ready to go in case the tax department has any questions down the line. So what exactly should be in that file? Well, you'll want a comprehensive record, all the bills and invoices, any agreements with consultants or service providers, proof of payments, TDS records if they apply, and of course the actual feasibility or project reports themselves. Seriously, think of this as your compliance safety net. It's better to have it and not need it than need it and not have it. Okay, for all the professionals and seasoned business owners watching, this next part is especially for you. The Income Tax Act 2025 replaces the old 1961 Act, and there are some really significant changes in this provision that are actually great news for taxpayers. So here's one of the biggest and best changes. Under the old law, Section 35D, businesses had to spread these costs out over a full decade. You could only deduct 1/10 each year. The new Section 44 is a huge improvement. It cuts that period in half to just 5 years, letting you claim a much larger deduction of 1/5 every single year. What this means for you is you get that tax benefit much, much faster, which helps your cash flow right when you need it the most. Another fantastic simplification in the new act is the terminology. Remember the old, sometimes confusing concepts of previous year and assessment year? Well, they're gone. They've been replaced by a single, streamlined term, tax year. This simply means the financial year, making the entire timeline a whole lot more intuitive and easier to follow. Now, to make sure your claim goes through without a hitch, it's just as important to know what not to do. So let's quickly cover some of the common pitfalls that can get a claim disallowed. Think of this as your what to watch out for list. First off, don't try to claim expenses that aren't on that specific list in Section 44.2. If it's not on the list, it doesn't count. Second, make sure the numbers you report in Form 5 match your books of accounts down to the last rupee. Any mismatch is a red flag. Third, remember, the audit is not optional. Failing to file that audit report in Form 6 is an absolute deal breaker. And finally, watch that deadline. As per Rule 27, these forms have to be filed 1 full month before the due date of your income tax return. Don't be late. Okay, we have covered a ton of ground. So to wrap things up and make sure it all sticks, let's condense everything we've talked about into a simple, actionable checklist. Here are your 5 key takeaways. First, the deduction is 1/5 of your cost, claimed over 5 straight years. Second, your total claim is capped at that magic number, 5% of the project cost or capital employed. Third, a CA's audit report isn't optional, it is mandatory. Fourth, document everything meticulously. And finally, number 5, file Form 5 electronically, and most importantly, on time. If you follow this checklist, you'll be on very solid ground. So, I'll just leave you with this final thought to chew on. Whether it's for your own business or for your clients, are your records organized and ready right now to take full advantage of this incredibly beneficial provision under the new tax law? Thank you so much for watching this breakdown of Section 44. If you found this explainer helpful for your business or your practice, please do us a favor and like, subscribe, and share it with other entrepreneurs and professionals who could really benefit from it. And just a final important note, this content is for educational purposes only. Tax laws are complex and they can change, so you should always consult with a professional advisor for your specific situation before taking any action.